The stock market can be confusing. Sometimes it makes sense. Stock prices go up when a company makes money and down when it loses money. But other times, the market doesn't seem to match what's happening in the real world at all. Why? Because the stock market lives in the future. It reacts to what it thinks will happen months from now, rather than what is happening today. This time gap is what makes it so tricky for new investors. Most people wait for the news to tell them things are getting better before they buy stocks. But the stock market is like a crystal ball, it tries to predict the future. It usually starts moving up 6 to 9 months before the actual economy improves. By the time experts on the news say that bad times are over, the best stocks have already been going up for a long time. If you wait for the good news, you've already missed the best time to buy. When the market is at its lowest point and everyone is worried and gloomy, that is actually the exact moment when the most successful investors are quietly buying everything up. The stock market is the only store where things go on sale for 50% off, but everyone is too scared to shop. The same thing happens in reverse. When a long period of rising prices, a bull market, is about to end, stocks will start to drop even while the experts on TV are still saying, everything is great, and the future looks bright. If you only make decisions by looking at old news, like how much money a company made last month, you will always be too late. By the time you realize things are bad, the market has already crashed. Richard Wyckoff was a famous trader who realized that a stock's price is like a sneak peek at the future. He stopped listening to the news and rumors. Instead, he practiced tape reading. This means he looked closely at charts to see how much the price moved and how many people were buying or selling, volume. He believed that watching what the market actually does is much more important than listening to what people say. Richard Wyckoff discovered that the stock market always moves in a circle made of 4 parts. Think of it like the life cycle of a trendy new gadget. 1. Accumulation, the secret phase. This is like when a few tech experts hear about a cool new invention before anyone else. They start buying it quietly while the price is still low and most people aren't paying attention. 2. Markup, the hype phase. Word gets out. Everyone starts talking about the gadget, and everyone wants one. The price shoots up fast as more and more people rush to buy it. 3. Distribution, the selling phase. The gadget is now at every store and the price is very high. The experts who bought it early realize it won't get any more popular, so they start quietly selling theirs to the people who are just now arriving late to the party. 4. Markdown, the crash phase. Eventually, there are no more buyers left. The hype is over, and the price begins to fall. People who bought late get scared and sell for a loss, and the price drops until it becomes cheap enough for the cycle to start all over again. In short, learning these 4 phases is like gaining a superpower for reading charts. Instead of looking at the past or worrying about yesterday's news, you learn to look forward. Stop focusing on where the economy has been and start focusing on where the stock price is actually going. If you're finding this breakdown of the Wyckoff method helpful, hit that subscribe button. We're building a library of simple guides to help you stop following the news and start following the smart money. Don't miss our next deep dive. Happy investing!